Hi guys, welcome back to the 7-day stock market bootcamp day 3. I am so pumped and so excited today as we have finished all the basics of stock market. We have finished all the boring topics of stock market. So today is going to be really fun. Today is going to be interesting and fun. Alright, so guys, today I want you all to be attentive. I want you all to pay as much attention as possible because things are gonna get serious today. Alright, so on that note, let's get started without wasting any time. Welcome to the 7-day stock market bootcamp, guys. Day 3, which is called the Open Cup. And yes, let the fun begin. So let's talk about why do the markets actually move. Like you might have heard people say that, people always keep saying, just switch on the news and you'll hear the anchors saying that the markets went up by 200 points, the market fell down 500 points, the markets were bullish, the markets were bearish. So for those of you who do not know what bullish and bearish means, if the markets are going higher, it's called as a bullish market. If the markets are coming lower, if the markets are falling, it's called as a bearish market. It is as simple as that. So why do the markets move? Like, who makes the markets move? Is there anybody sitting in NSE and BSE and deciding where the market should go? No, that's not the case. Is it already decided by someone that the markets are going to go here and the markets are going to go there? No, it is not a decision that a person takes. All right, to understand why the markets move, you need to know what supply and demand is. Right, it is a very simple concept. You might have learned it in school. All of us have learned what supply and demand is. Right, so the answer to why the stock market moves is supply and demand. So what is supply and demand? Let's talk about it. If the supply is greater than the demand, the prices will always be low. And if the demand is higher than the supply, the prices will always be high. In a nutshell, this is the definition of stock market. Supply and demand. Alright. So it's a universal rule. Higher the demand, more will be the price of that product. Similarly, higher the supply, lesser will be the price of that product. So now let me try to give you an example so that you understand the concept of supply and demand in a much better manner. So just imagine that there are only 100 apples left in this entire world. There are no more apples, just 100 apples, right? And I somehow managed to purchase 60 of them. So out of 100 apples, I own the 60 apples right now. So what I am going to do is that I purchased 60 apples out of the 100 apples that are there in the entire world. I purchased 60 apples at 100 rupees per apple, right? So 100 rupees per apple is the price that I have paid to purchase 60 apples. I purchased those and I sold it to this person right here, who we are calling the dab man right now, for 200 rupees per apple. So what happened here? The demand for the apple right now is very, very high because there are only 100 apples available. Even if I would tell the dab man that I'm going to sell these apples for 300 rupees or 400 rupees per apple, even then the dab man would buy it because there is no one else who is selling the apples right now, because I have the 60 of the apples in this entire world. He needs to be very lucky to find someone who owns or who has the other 40 apples which are remaining, right? Let me explain it to you with the graph now. So I purchased the apple at 100 rupees, right? The price is right here. I purchased the apple at 100 rupees. I further sold it to this guy, who we are calling the dab man, at 200 rupees. And then this person further sold it to someone else at 300 rupees. Right? So you see how the price of a product is going higher and higher because of higher demand. And then this person also somehow manages to sell it to someone else at 350 rupees. So I purchased it at 100 rupees. I further sold it to somebody at 200 bucks, and then he sold it to somebody at 300, and then from 300 it went to 350 rupees. So now the person who purchased these apples at 350 bucks, he is stuck. The people are not willing to pay anywhere more than 300 or say 350 rupees to purchase apples. So what is this guy going to do now? Well, it is very sad for him that he will not be able to sell his apple further to anybody else. So what he's going to do is that he's going to reduce the price of his apple and he's going to further sell it to someone. So now you understand why do the prices go higher and why the prices come down. It's a very simple concept of supply and demand. Higher the demand, higher the prices. Higher the supply, lower the prices. As simple as that. If you understood this, guys, congratulations, you have understood half of whatever you need to learn. Alright, you have learned 50% of stock market. This is all stock market is. Now let's talk about if is it possible to make money in the falling markets? Yes, it is possible to make money in the falling markets only in stock market, not in the real world where you're dealing with apples and bananas. All right, let me try to explain it to you with an example. This is the same graph. This is the same previous graph of the apple prices. I purchased it at 100. It went to 200, 300, 350, and then the price was too high for people to pay for apples, and then the prices started falling from there. So now I know that the price of apple has gone too high. The people are not willing to pay 350 rupees to buy apples. So what do? I simply borrow apples in the sense shares. I simply borrow shares from a broker to sell it to someone who is willing to buy it right here in a downfalling market, because that person thinks that the market is going to go higher again. So I just simply purchase shares from a broker, I sell it to him, and when the markets fall, this person who purchased the shares from me is going to make a loss, and that loss is the profit which I make. Not able to understand? Just give it a moment. It will take some time for you to understand this. The process of short selling or the process of making money in the downfalling market is pretty simple, guys. You simply borrow stocks or you simply borrow shares from a broker to sell it to someone who is willing to buy in a falling market. You simply take the shares from your broker, give it to that person, sell it to that person, and whatever loss that person makes, that is your profit. As simple as that. Now let's talk about how do we read charts. So when I say charts, this is what comes into your mind, right? The prices, the graph going high and low, the x-axis is the time and the y-axis is the price, right? So this is high school stuff. This is like the normal stuff that everybody knows. This is also one of the ways you can read charts. This is also one of the ways that you can get to know what the price of a stock is, what did it do in the past, what it might do later in the future. This is also one of the ways, but there are better ways of reading charts, right? So let's talk about what candlesticks are. Candlesticks are a way that traders use to navigate and to read charts, to read prices, alright? So candlestick basically consists of three things. One is a candlestick body. The green block that you see right here is the candlestick's body, and then this is a wick. All right, it's pretty simple, no rocket science. What you see right here is a wick, and there is one more wick at the bottom. So a candlestick consists of three things. One is the body, and then there is an upper wick, and then there is a lower wick. So if a candlestick is green in color, what does it mean? It simply means that the prices started at this particular point, right? It's written right here, open, right? And then it came down until the end of the lower wick, which is the low. And then from there on, it went on higher to the higher point of the wick, which is the high. It is as simple as that. If the candlestick's body is green in color, it opened at the lower part of the body, went lower till the lowest point of the wick, came higher till the highest point of the wick, and then finally closed at the top of the green candlestick's body. As simple as that, guys. And if the candlestick is red in color, it is just the opposite of it. The prices opened at the top part of the body, came down till the lowest part of the wick, went higher till the highest point of the wick, and then finally the markets came down to close at the lowest point of the red candlestick's body. If at all you haven't understood this, please rewind the video, watch it again. It's pretty simple. So a green candlestick will be called a positive candle because the prices have opened low and closed high. The same way a red candlestick would be called a negative candle because the prices have opened at the top and it has closed at the bottom. As simple as that, guys. And the wicks just show you the range the prices have covered before closing. So there are different time frames for this, alright? So one candlestick can show you the data of different time frames. So if at all I want to see the movements that have happened in a time frame of 3 minutes, I can set it that way. If at all I want to see the price movements that have happened in a time frame of 5 minutes, I can do that also. Don't worry about all these things, we're going to get into it later. For now, you just need to understand what candlesticks are, and I hope it's clear by now. This is how a candlestick chart basically looks, and this was a line chart. It's pretty simple, pretty normal, nothing to get confused about. This basically means that the prices have gone higher and it's come lower here, gone higher, it has fallen here, higher, lower, higher. As simple as that. The only thing this shows you is the price versus time, nothing else, right? So now this is also a chart, but this is a candlestick chart. Here you see that in this particular candle right here, you see that the prices have opened here and the prices have finally closed somewhere here, right? And the same way you see in this example that the prices have opened at this point, or where it has gone higher all the way up until this point, and then it finally closed here, right? And apart from the mini details, apart from these small details, you also get to know what the markets have done overall, accumulatively. The markets have gone higher from this point onwards, and it has fallen down. It has touched this point, it came down all the way until this point, then it went higher, came lower again, up, down, up, down, up, down, up, right? So this just gives you one extra dimension of information. In a normal line chart, you just get to know where the prices have gone with respect to the time. But in candlestick, you get to know where the prices have gone, but you also get to know where the prices opened, where the low was in that particular time, where the high was, and where did it finally close. So what is the use of having that one extra information? We will understand that later. For right now, what you need to understand is that reading price through a candlestick chart is much better. So now that you know how to read charts and how the prices keep moving up and down, let me explain to you the psychology behind the movements of the market. Like, what is happening here at this point that the markets have gone higher? Why did the markets go higher from here and then higher from here again, and then it finally took a dump, right? So here is a same chart of the apples, right? I purchased the apples at 100, I gave it to someone at 200, and then the prices went all the way up to 350, and then when the prices came down again all the way down to 100 where I had previously bought, what I do is that I do not want someone else to buy it at 100 rupees and then sell it lower to someone else. I do not want that to happen. Also, I do not want anybody else to have the apples at the price that I have purchased, right? Because that would increase my competition. So what I do is that as soon as I see that the prices have come back down to the price where I previously purchased apples, I start buying more and more apples. I start buying apples like crazy, alright? So that again makes the prices go higher, because obviously I am buying more and more apples here. So whatever the selling pressure comes, it has to come from me. If at all somebody is selling apples here, it has to be me, because I am buying all the apples. I am buying all the apples, I have all the apples, so only I can sell those apples, right? So I do not sell it anywhere lower than 100 rupees. I sell it only if I get a buyer who is willing to purchase it for more than 100 rupees, right? So this is simple, guys. This is something that you need to understand. Let me explain it to you once more. I purchased the apples at 100, I sold it to someone for 200, then that person sold it to someone for 300, and then from 300 the prices went up to 350. Then the people were not agreeing to pay any more than that for apples, so then the prices of the apples started coming down, because this person right here was not willing to hold the apples, and he was like, okay, now nobody's buying the apples, what do? It's better I just give it at a lower price, and at least I will get back some amount of money that I invested, alright? So then the prices keep coming back lower to the original price where I previously purchased it, right here at 100 rupees. So what I do is that I purchase more and more and more apples, so that nobody else should be able to purchase apples at a price lower than mine, or even at the same price that I have purchased them, alright? So I purchase as many apples as possible here at 100 rupees, so that I later can sell it to people who are willing to pay more than 100 rupees, alright? So this is the psychology behind the markets. Also, let me show you the other side of the coin, right? Someone else purchased the apple at 100 rupees right here, and then he sold it to someone at 200 rupees, and then from 200 it came all the way up to 300 to 350, 400, alright? So now at this price right here, 350, 400, I feel and I know that people will not pay more than 350, 400 rupees to purchase apples, because come on, who does that? Have you ever heard someone paying 400 rupees for one apple? No, right? So now I know that people will not be convinced to pay 300 to 400 rupees for the apple. So what I do is that I sell all the apples here. I sell huge amounts of apple right here at 400 rupees. So when the prices come down, because I am selling, right, I am doing some heavy selling right here. So when the prices come down and the prices come back again to 400 rupees, right where I started selling, what I do is that I start selling more and more over here, because my conviction with the fact that the prices of the apple are not going to go any higher than 350, 400 makes me do it. It makes me sell more and more apples at the same price right here, alright? So this is the psychology behind the markets, and this psychology of supply and demand is what makes the markets move. Everything else is noise. All right. So now let's go on and see how do you use a charting platform. How do you read charts? So if at all you want to know what Tata Motors did today, or if you want to know what Reliance did today, what do you do? Like, where do you go and see it? You need to have a charting platform for that, right? So let's get into it. And I will not be going too much in details, because if you use that platform for 2 or 3 hours, you will know all about it. So I'm just going to show you a few important points so that it helps me teach you the thing that I want to teach you further. So let's get into it. I'm simply going to type trading view and then click on charts. So guys, this is how trading view basically looks, right? It's pretty simple. It is just normal candlesticks, and by now you know how to read candlesticks. So now let's talk about different time frames, right? You can see it right here. I have set my charts right now in 5 minutes, right? I hope you can see it. It's highlighted in blue color. So what that basically means is that every candlestick that you see took 5 minutes to be developed. So if the markets are opening here, it went down till here, and then it touched the high of this point, and then it finally closed here. All of this happened within a time frame or a span of 5 minutes. All right. So please understand that. If at all I shift it to 3 minutes, you will see that the number of candlesticks have increased, because now each candlestick is representing a very small amount of time. Previously it was 5 minutes, now it is 3 minutes. This particular price action that happened here, right, this happened in a time frame or in a span of 3 minutes, because the time that we have set here is 3 minutes. The same way you have 1 minute, the same way look at a 1 minute chart, you see so many candles, right? And then the same way there is 3 minutes, and then there is 5 minutes, there is 15 minutes, there is 1 day also. So 1 day chart basically shows you the price movement that has happened over 1 day, in a span of one entire day. It's written right here, 26 August 20, which is today. All right. So this particular candle, which is right here, shows you the price movement that happened on this particular day, on 26th August 20th. Also, the chart that you're able to see right here on the screen is of Bank Nifty. So what is Bank Nifty? Bank Nifty is a sector which consists of all the banks. I hope you remember that, guys. So now what if you want to change the ticker? You just click here on the chart and type Reliance, RELIANCE, Reliance Industries. So these are the movements that have happened in the Reliance today. So now say if you want to check what Tata has done, you just click Tata and then you click on whatever script or whatever ticker you want. So that is how you change the script. And also you can create a watch list here. You can just type in the ticker name right here, and you can just click on plus, and it's just going to be added here to your watch list. Also, these are the tools that I use. You can just simply click on each one of these and see all these tools that are there, right? So let me show you what these tools actually do. Trend line, it basically draws a line, all right? And this, with the help of this tool, you can draw a horizontal line, and this helps you draw a rectangle. So this tool right here, forecast, it tells you how many points or what was the magnitude of that particular trend. So you click on the top and then the bottom, you see that this move right here from this top to this bottom was a move of 275 points, right? Brush is for you to draw something on the charts, all right? And then this is also one of the horizontal lines. This line goes through the entire chart from left end to the right end, and that's it, guys. You just have to open a tradingview.com, use it for 1 or 2 hours, you'll get a good hang of it. So now let's continue. There are different phases in the market, all right? The first phase is the phase of an uptrend. You see that the markets are going higher, right? And then there is a phase of sideways trends, and then there is a phase of broadening trend, all right? And then there is a phase of downtrend. It's not that, if a market is going higher, it will just keep on going higher forever, or if the markets are coming lower, the markets are going to keep coming lower. There are different phases and cycles in the market. The people who are responsible in making the markets go high, they need time to decide where to take the markets next. They need to decide if there is some more juice left for the markets to go higher, or if is it better to take the profits and make the markets go lower. It is as simple as that. So if the markets go higher, it's going to consolidate, and then the next direction of the market is decided. You don't have to worry about the phase B and the phase C being sideways and broadening trend. You don't have to worry about that. All you need to understand is that once the market goes higher, then the market consolidates for a while, and then the market either falls down again or the market goes higher. As simple as that. Now let's talk about the candlestick patterns. You know what candlesticks are? Candlestick basically shows you the open, high, low and close of a given time frame. So this is a green candle, so it opened here at the low point of the body, came all the way down till the low point of the wick, went higher to the top part of the candlestick's body, and the prices finally closed, right? What's happening here is that the prices opened here and it came all the way down to this point right here. So what happened after that is that the buyers aggressively bought, right? They purchased aggressively. They wanted to send the prices back up, so they start buying and buying and buying, and then the prices finally come up and they close here. Just try to imagine the same thing that I tried to explain right here. The prices were going up and the prices finally came down. I was very eager to purchase more and more and send the prices back higher, right? So the same thing is happening here in this example also. The prices, when they come down, buyers are aggressively buying so that the prices go back higher. So once this happened, the prices automatically started going higher, right? So this is called a hammer. See guys, you do not have to memorize the names of these patterns. You just need to understand the psychology behind it. If I keep teaching you, if I keep telling you the names of different patterns, you're just gonna get confused. It'll be like, you're mugging up things. You do not have to mug up things. You need to understand the logic and the reasoning behind whatever is happening. So you need to know if this is happening, what is the reason behind this? If you know the reason, you will not ever require to memorize these names: the hammer, bullish, engulfing, doji, morning star, and all those names. All right, all you need to understand here is the psychology behind what is happening here. All right, there was a up run, there was a run, there was a pump, and then the markets fell down, and then you could see a hammer, and then after that the markets went higher. That is all you need to know. Now let's go to our next pattern, a bullish engulfing pattern. So what happens here is that there is a small red candle, and then the green candle which is formed after that red candle totally eats up that red candle. It engulfs the previous red candle. So what does this tell you? This basically tells you that the buyer who came in at this particular point are so aggressive that they nullified the entire negative effect of the previous candle. That is all you need to know here. And showing you an example of it, the markets went higher here, it came back lower, and at this particular point, this region, this zone here, you need to be able to see this very clearly. There is a red candle here, and then the green candle which was formed after that right here. This green candle I'm talking about. This green candle completely engulfed the previous red candle which was there, right? So what this shows us is the power of the buyers there. This shows us that the market is bullish. The people who want to see the prices go higher are much more in number. People who want to send the prices higher are very aggressive. They are much more in numbers when compared to the sellers. Going on to our next pattern, it would be a spinning top or a doji. A doji simply means confusion in the market. The sellers are confused, and at the same time the buyers are confused. They do not know where to send the markets. They are confused. They do not have a clear perception about it. Alright, so every time you see this, the chances are that the market's direction will change. Just have a look at this example here. The markets have come down, then it has gone up again, then again it came down, and then you could see a doji right here. And once this doji was formed, the markets took a turn back. The same way, example on the other side, the markets went up, and at this region there was a doji there, and then the markets took a turn and it came back down. Now let's talk about a shooting star. Shooting star is just the opposite of hammer. In a hammer, the lower wick was long and then the body was of a green color. Here the upper wick is long and the body is red in color. So what this means is that the selling pressure from top is high. high. It is more. It is greater than the buying pressure. Every time the price tries to go higher, the buyers push it back down, and then the markets finally start to fall. And in the example right here, the markets have gone higher, and then there was a shooting star. The markets tried to go higher. I hope you can see that wick over there. As the market started going higher, the sellers came in and they pushed the market back down, and the market started falling from there. As simple as that, guys. I hope you're able to understand it. There is no rocket science in it. It's pretty simple. Now let's talk about the next pattern, bearish engulfing. It is just the opposite of bullish engulfing. There is a green candle which gets formed, and then there is a red candle which completely eats away the previous green candle, and then after that the market starts falling. And for the example, there is a green candle right here, and then there is a red candle right next to it. The red candle is much bigger, much stronger, and it is engulfing the previous green candle. So once this is done, the market starts falling. Right? So now, guys, what did we understand? What are candlestick patterns? Candlestick patterns basically show you the mood and the behavior and the sentiments of the market. But don't get me wrong here, just knowing what candlestick patterns are, just knowing the psychology behind them will never help you in taking good enough trades. You will never be a successful day trader just by knowing what candlestick patterns are. Candlestick pattern is just an add-on. It is like it's just like an icing on the cake. You need other things to build perception about the markets. You need other things to build your view and solidify your view towards the markets. Candlestick patterns are just the confirmation. All right. So what are the other things that you need to know before taking a trade or before building a view about the markets? Let's get into it. We're going to start with chart patterns. What are chart patterns? So now you know that the markets move solely because of psychology, right? Psychology, supply and demand. So there is a way of understanding what the market participants are thinking just by looking at the charts. What I mean by that is that you can look at the charts and you can tell that this particular region had too many sellers and this particular region had too many buyers. And these buyers are the ones who made the market move a certain way, and these sellers were the one who made the market move in a certain way. Let's get into it. Let's talk about what support and resistances are. As you can see right here, the markets are just shuttling between these two lines, the top line and the bottom line, right? The top line is called resistance and the bottom line is called a support. And don't get me wrong when I say line. A support and a resistance are never a line. These are zones, all right? These are thin zones from where you basically can make out that, yeah, the market, whenever it comes to this particular region, the markets are falling from there again and again. So whenever the markets come to this region, the markets are going higher again and again. So support and resistance basically are zones, all right? So a resistance basically means when the prices keep coming down from that region again and again, and support basically means when the prices keep bouncing back or repel from that particular zone. All right, so this is support and resistance. Why does this happen? Let me explain it to you with a graph. So what is the psychology behind support? I've already explained this chart to you guys. I buy it at 100, I sell it to someone at 200, and then the prices finally go up to 350, and then from there the prices come down. Right, it comes back to the same price, which is at 100 rupees. What do I do here? I buy more and more so that I can defend my prices, and then the prices go higher. So what was the support here? 100 rupees was the support. Right, I hope this is crystal clear to you guys. You need to understand this, guys. This is very, very, very important. So now let's talk about the psychology behind the resistance. The prices of the Apple came all the way up to 350, 400. I know that people will not be willing to pay more than that for. What do? I borrow stocks or I borrow apples from a broker, and I sell and sell and sell apples. I sell more and more apples because I know that the prices of the apple are going to fall from here. All right. So the prices of the apple fell down, and when the prices come back again on top, wherever I had sold it, I sell aggressively again. I sell more and more and more again because I know that the prices are not supposed to go any higher than this. So what happens is that the prices fall from that point onwards. So where was the resistance here? Right here at 350. All right, this could be 350 or this could be 400. All right, so basically this zone right here was the resistance. Okay, so 2 points here. Support, resistance, they are basically the zones. They are zones where the buyers or the sellers get activated. Point number 2, resistances and supports are not lines, they are zones. Now let's talk about what trend lines are. Trend lines are nothing but support and resistance, but trend lines are not a straight line. We saw it in the previous example that there was a zone at the bottom, there was a zone at the top, and the prices were fluctuating in between them, right? The same way, trend lines are also zones from where the prices are either repelling towards the top or prices are coming down from the top. All right, so if the trend line is at the bottom, it will be called a support. If the trend line is at the top, it's called as a resistance. So what is happening here? There is a trend line right here. There is a very clean trend line. I hope you all can see it, right? And then every time the prices go and touch that particular point, the prices fall. Every time it goes back higher again, the prices fall from there. Higher, lower, higher, lower. Whatever happens, you can see that the prices are not able to cross this line, right? So this trend line at the top is acting as a strong resistance. The same way here, every time the prices come to this particular point, this line right here, the prices repel from there. It goes higher. Every time it comes lower, it repels from there. Lower, higher. Whatever happens, the prices are not coming any lower than this trend line right here, which acts as a very strong support. Now let's talk about double tops and double bottoms. You guys already know what a resistance means. Resistance basically is an area at the top from where the prices are going to come down again and again, right? So what we see here is that the prices came down from this region onwards. It came down, all right. It came back to the previous low, and then the prices went back again higher to the same region, and then the markets fell down from there. But what you are missing here is this particular region right here. What is this candlestick right here? The first and the second candlestick you see right here. Go back into the video, rewind the video, see what the candlestick formation pattern that is, and let me know. Now that the double top is done, let's talk about double bottom. Double bottom is the same as double top, but it is at the lower region. All right, there is a strong support here at the bottom, so whenever the prices come back down here, it gives you a good candlestick formation pattern, and then the markets go higher from there. So double bottom, double top, just the same thing. It's just that these are the two different sides of the same coin. Now let's talk about a much more complicated pattern that you get to see on the charts on a very frequent basis. This is called a rising wedge. There is a resistance at the top, there is a support at the bottom. All right, see, we do not care if this pattern has a probability or has a plausibility of breaking at the top end or the lower end. We do not know if the markets are going to go this way or if the markets are going to go this way. But what we know is that once this trend line right here at the top or at the bottom breaks, we are going to take a trade that way. All right, so here what happened was that the resistance was taken out, the resistance line was broken. All right, so from there on the prices started going higher. So what are we going to do? As soon as you see this break right here, you know that you are not supposed to short sell, you are not supposed to take a trade in favor of the markets going down. You are supposed to be a buyer here because the resistance has broken. All right, the same way in this example, once the support was broken, the markets fell drastically. So you know that once the support is broken, you are supposed to be a seller. You're supposed to be in the favor of the markets going down. It is as simple as that, guys. All right, again, what you need to understand here is that memorizing the names of the pattern is not at all important. You know what supports are, you know what resistances are, you know how to draw them, you know what trend lines are. All right, so once you are able to identify a zone, once you're able to identify a support and a resistance, once those zones are broken, you know which side to take a trade. It is as simple as that. Please do not memorize these names, you'll just get confused. You just need to know what is the psychology behind it. You need to know what is the reasoning and the logic behind this. That is all that is going to help you guys, not memorizing these names. Memorizing these names will make you look cooler, but it's not going to help you better your trading game. All right, now let's talk about the ascending triangles. Again, what are all these patterns? All these patterns are just a combination of trend lines. It is nothing else. You can see it right here. There is a resistance and then there is a support right here, which is a trend line again. All right, so once either this line breaks or this line breaks, you know what side to take a trade. So in this case, what has happened is that the top line, the resistance has broken and then it came back for a retest and then the markets have gone higher. The same way, if the lower line would break, it would come up for a retest again, and this is the point where we would go short and we would wait for the markets to go down. Why? Because the support has broken. As simple as that. Now let's talk about head and shoulders. So what happens in head and shoulders is that the price goes higher, it comes back lower, it somehow manages to break the previous high, and then it comes back lower. This region right here is called as a fake out. So what we have learned until right now is that once the support or once the resistance is broken, the markets are supposed to go higher. But what happens a few times is that the market refuses to go any higher, and then it comes back to the previous low, and this is called as a fake out. Alright, so when this happens, when you spot a fake out, you need to be prepared. It can be a head and shoulder pattern. Alright, so the markets went higher here, came down, it gave a fake out right here, right, and then the markets came down again, and then the pump which happens after this, at this particular point, it does not come up till this high, it comes only until this high right here. This is called a shoulder. Alright, so it comes back up till the shoulder, and then the markets fall down again. Alright, so this is a left shoulder, this is a right shoulder, and this is called a head. So in our example right here, what has happened is that the markets have come up, went down again, then it gave a fake out. This is the head right here, this is a left shoulder, and then the prices fell down from there, it came back up again to the shoulder, this is the right shoulder, and then the markets fell down. Okay, so this is called a head and shoulder pattern, and the same way there are millions of patterns, guys. You do not have to memorize all those patterns. Okay, you just have to know how to identify the support and resistance zones. Any place where you see there is a lot of rejection happening, or any place where you see there's a lot of support which is being taken, just draw those lines and you will automatically see one or the other pattern there. It'll either be a descending triangle or a ascending triangle, or it'll be a head and shoulder, or it'll be a normal double bottom or a double top. So once those zones are taken out, you know what to do. Alright, but let me just explain these patterns to you. There is a downtrend, and then there is a triangle which is formed, right? You can see it here. There is a triangle which is formed. If you draw a line from the low wicks and the top wicks, you get to see that there is a triangle forming there. If at all the top line would break, we would be buyers, and here in this example, the lower line, the support has broken, so we are going to be sellers here. Alright, the same way there is cup and handle pattern, the same way there are descending triangles. What's happening in a descending triangle is that the prices are from lower highs every single time. Just have a look at this. The prices went higher, it came down, alright, but this time when the prices went higher, it did not even go till the previous high. It started coming down from way before that. So it made a new high here, and then again when the prices went higher from here, it did not come till the previous high, it came back right from the between. And then finally the support was broken. So what happens in this pattern in the descending triangle is that once you spot this line at the top and the bottom, and once you see it forming lower highs, you need to be prepared that the pattern formation towards the downside is much higher. The possibilities of the price action breaking towards the lower side is much higher. So guys, why is it important to know these patterns? Why is it important to know these zones and draw them and be prepared for the next move? The reason why we do that is because it simplifies our job. Drawing these patterns and knowing these patterns help us understand the psychology and the mood behind the markets. For example, in this scenario right here, when the markets came down, there were obviously buyers who were pushing the markets higher from here. So what happened in this zone was that the sellers were so strong and so powerful that they did not even allow the prices to come back to the previous high. The sellers just jumped in and they started selling it aggressively. So that is the reason why the prices came down. And again, when this low right here was taken out, right, there were again buyers who came in at this particular region and they sent the markets back higher. Again, this time the markets did not come till the previous high, but the previous low was broken. So when these sellers came in, they pushed the market down so hard that the entire pattern broke. So just think that you had just drawn these two lines, alright, and nothing of this had happened. Right? So looking at this pattern right here, the lower highs which are getting formed, you would be prepared that yes, possibilities of the market breaking this particular support here and the markets going down are pretty much high. So this is the reason why you need to understand what patterns are, not memorize the names. All right, you need to be able to draw these zones and just wait for one of those zones to break. It is as simple as that, guys. All right, so now let's try to go a little deeper into this and let's see what market profiles are. So guys, what is market profile? Market profile is a graphical representation that shows price and time information as a distribution. Key benefits include determine amount of time number blah blah blah. Who has ever understood anything just by reading the definition? So let's just straight away get into it, and I'm going to show to you what market profiles mean. Just ignore all of this for now, guys. Just ignore all these letters right now. Just look at this right here. Look at this region right here. What is happening here? These are simple candlesticks. The markets opened here, it went down till this point right here, and then the markets went back higher. It came back up till the top wick, and it finally went down and it closed here. So overall the markets have gone higher in this particular region. Then the markets went all the way up till here, fell down again, went higher, came down. So basically these were the movements that happened. Markets went higher, came down, higher again, and then again came back lower, right? So what you need to do now is just replace these individual candlesticks with letters. So this first candle right here, just replace it with the letter D. The second candlestick, replace it with the letter E, F, G, H, I, J, K, L. What have we done here? We have simply replaced the candles with the letters right here. So once you have done this, bring all those letters close to each other. Just compress all those letters by bringing all the letters close to each other. We made sure that there is no gaps anywhere here in between, and then we compressed all these letters together. So when we compress these letters together, what do we see here? We see that the letters are placed next to each other in a very beautiful manner. And also in the between there is a zone where most of the letters are being printed. So what does that tell us? This tells us that most of the trading that happened during this particular time happened at this region right here. Alright, so with the help of this you find important levels. So now let's get into charts and I'll show you how market profile actually works. It's a free website called as Go Charting. So guys, I have set up the chart here, and also it's the same thing as trading view. You can click here, you can set the time frame, but for market profile 30 minutes is the best time frame. So now what's happening here? You see that there are letters here. You already know what these letters are. This blue line that you see here is called as initial balance. Initial balance basically means the movements that happened in the first hour. Alright, from 9:15 to 10:15. So what is the significance of an initial balance? Initial balance basically tells you the region or the area that needs to be broken for you to get a good enough movement. Alright, it is as simple as that. Initial balance basically tells you that if this particular region breaks, there might be a huge move which might happen. And then there is this area right here, the shaded one, that is the value area. Alright, top area is called the value area high, value area low, and the line in between, the red line which you see, this line is called the POC, point of control. Point of control simply is a line where most of the letters are being printed. What is the meaning of most of the letters being printed? If this region, it has a letter A, C, D, E, F, G, H, J, K, L, it has most of the letters right here, right? So what this basically means is that the most of the trading has happened right here in this region, which is at the price of 23,026. All right, so that was the region where most of the buyers or most of the sellers were interested. That is where most of the trading happened. So if tomorrow market opens somewhere here and then the markets come up somewhere here, we know that it is a huge resistance. Or if the market opens somewhere here and then the markets come down lower here, we know that it is a huge support for the markets, because anything that comes from the top is a support, anything that goes from the bottom will be a resistance. And when a support is broken, it becomes a resistance. When a resistance is broken, it becomes a support. Let me explain it to you. Say this is a line right here, which is, say it is a support. All right, so the prices are right here. The price is coming down and it repelled from there. Okay, so now we know that the support has worked. So once this support is broken, after the support is broken right here, and if the prices try to come back to this particular area, this line which was a support previously now has become a resistance. The prices to cross this area, it will be a little difficult. Alright, so there are possibilities that the prices might come down from that region. So now let's take one more example. You see here, this line was the initial balance. So once this area was taken out, right here somewhere, all right. So once this area was taken out, the markets went high. And also at the same time, you have this gray area which tells you the value area high right here and the value area low, and also the POC right here. What is the POC? POC is the area where most of the trading has happened. So this was the market formation that happened yesterday, and this was the POC which got formed, and you can see that the markets have exactly come down till that point and then it has repelled. So you get the point here, right? Accumulating the data in a way that gives you zones, important zones of support, resistance and POCs. What are POCs? Support, resistance, it's the same thing again. So this is where the market profile helps us. The normal candlestick will not be able to tell you this. See, if at all I had to pull out the normal candlestick charts of the July 25th, I will not know where the most of the trading here has happened. It is all choppy. It has gone higher, come back lower, higher, lower, higher, right? It's very choppy. I do not know where exactly most of the trading has happened. I do not know those important zones which I need to keep in mind for the next day. So if at all I just switch to the market profile charts, and I know that most of the trading has happened at 23026. all right. So when I know these levels, when I know that 23026 is a very important level, what I do is that I just simply mark out these levels and I would wait for these levels to be achieved. I would want to see how the price action would be and the price would come down to this level, right? So this is the extra dimension that you get with market profiles. So there are two different shapes of profile, just like how candlestick patterns and normal chart patterns exist. So the same way there are patterns also in market profile. There is a P-shaped profile and then there is a B-shaped profile. P-shaped profile usually occurs when there is a short covering. What is a short covering? Do not worry about it right now. We're going to get into short covering later. But let me just tell it to you once. Short covering basically means when the people who shorted, people who thought that the prices are too high, and when the prices came down again, they made a good enough profit and then they cover their positions here. So whatever they sold right here, they cover it right here by buying it back. That is when the transaction completes, right? When you buy something, you wait for it to go higher, you sell it, you make a profit. The same way when you're selling something at a higher point, you wait for it to come lower, then you buy it back again. It is just the exact opposite of buying and selling. You sell first and then you buy. All right, so that is short covering. So when you see a P-shaped profile, it means that there is a lot of short covering that has happened. The same way when you see a B-shaped profile, what this means is that the people who purchased low, waited for the markets to go higher, made a good enough profit, they sold it right there and then the markets came down again. So this is called as long position unwinding. It is common sense, right? When you buy something at a lower price and you see the prices going higher, you are in a good profit. What would you want to do? You would want to sell your position and get out of the trade, right? So when you are selling because you are in profit, even that makes the markets come down. So this is called as long position unwinding. So 2 points here: short covering and long position unwinding. Now you know what both of these are. And guys, now it's time we talk about volumes. So what are volumes? Guys, this is so simple. I think you guys will laugh after you get to know what this is. Volume basically is the count, or it is the measure of the number of shares being traded in that particular region or in that particular time. So what has happened here, see, as you can see it right here, the markets have fallen. What does this mean? This means that the number of sellers selling at that particular area right here from here onwards were high. So obviously the volume candle which is going to be formed at the bottom is going to be pretty big. This volume bar shows us the number of shares that have been traded at that particular region. So usually what people do is that they use volumes to identify the fake breakouts. They usually use volumes to understand if the market, if the patterns are going to work or no. I personally do not use volumes, alright. I do not see their use because these volume bars are formed only after the candlestick is formed. So how am I going to utilize this? So this is the reason why we use market profile. In market profile, you get to know the volumes beforehand. You know where most of the trading has happened and you are already prepared to take actions in those particular zones, right? So I just had to let you know what volumes are and I have done it. That's it for today, guys. I'm going to see you tomorrow. Tomorrow the things are going to get really intense because today you have learned the patterns, you've learned the psychology behind it. You haven't still learned where exactly do you take trades, where do you place your stop loss, how do you analyze the markets in real time, how do you know when to take a trade, when not to take a trade. So we're going to get into all that tomorrow. Everything that you have learned today, please go through it once more. Please try to understand it. Please try to store it deep down into your hard disk. These things that you have learned today are very, very, very important. All right, and do not try to memorize the names of the patterns and the formations and all those things. It will just confuse you. Try to understand what is the reason behind whatever is happening. What is the logic? So once you have understood that, you will be unbreakable no matter what. Even if you come across a pattern which nobody has ever seen or nobody has ever written about, you will still know what to do. Alright, so this is the reason why I do not stress a lot over the names. So guys, go through the entire thing again, open up trading view, see what you can do, see what you can understand, draw trend lines, draw supports, draw resistances. Alright, and if at all you have any questions, any doubts, any queries, feel free to hit me up. Write down your questions on Slido. I will answer all those questions definitely. That's it guys, that's it for today. I'm going to sign off. See you tomorrow.